Cold open shock. Reframe. This wasn't fundamentals. This was forced behavior. What you just watched was not a market responding to belief, opinion, or political theater. It was a system responding to altered risk. Geopolitical headlines don't move price by themselves. Rules move price. Liquidity moves price. Margin structures and counterparty exposure move price. The so-called list only matters because uncertainty forces institutions to change what they are allowed to hold and how quickly they required to protect themselves. That's why it felt nauseating. That's why people were glued to every tick. That reaction isn't weakness. It's how human psychology responds when mechanical systems start repricing in real time. Metals didn't move because someone believed a story. They moved because desks were compelled to reach for protection. In a minute, I'll show you the one signal that tells us whether this becomes a breakout or liquidation trap in the next decision window. What actually happened? A mechanic's trigger. What matters here is separating the event from the trigger. The event was a statement. The trigger was what that statement did to institutional risk perception. When geopolitical uncertainty spikes, the first thing that changes is not price. It's counterparty assumptions. Who might be sanctioned? Who might face funding stress? Which exposures suddenly carry headline risk? That shift forces desks to rerun volatility models, stress tests, and exposure audits in real time. They don't ask whether they agree with the narrative. They ask whether their positions still meet internal risk limits under new assumptions. That process almost always begins outside equities, because metals, currencies, and energy are tied directly to collateral, hedging demand, and funding channels. They are where protection is cheapest and fastest to obtain. As those models update, options books are rebalanced. Gamma exposure changes. Collateral haircuts are reviewed. Funding desks adjust what they are willing to lend against. That alters the cost of holding leverage across the system. When those costs move, algorithms are forced to reduce, rotate, or neutralize positions. That is why spreads widen. That is why price jumps gaps instead of steps. It is not enthusiasm. It is plumbing adjusting under pressure. What made this feel violent wasn't volume. It was how thin liquidity became once protection demand hit a market that was not positioned to absorb it. And in a moment, we'll look at why this kind of move so often appears near turning points rather than trends. The market didn't believe anything. It recalculated risk. Why it felt violent. Forced selling. Plus, liquidity. Thin liquidity environments are not quiet markets. They are fragile markets. They are conditions where there are plenty of opinions, but very few firm commitments to stand in front of price. In those environments, moves don't travel through a crowd. They fall through air. When sudden protection demand appears, there are not enough resting offers to absorb it. So price jumps until it finds someone structurally required to respond. That is why this did not feel like trading. It felt like slipping. Inside those conditions sit forced sellers, leveraged funds whose margin sensitivity is measured in basis points, hedgers whose mandates require them to rebalance when volatility thresholds are crossed, options dealers whose books flip from neutral to directional when gamma changes. None of them are making judgments about value. They are responding to rules. When those rules are triggered at the same time, selling becomes reflexive. Stops cluster, liquidity gaps, and options hedging turns small moves into larger ones as dealers must chase price to stay neutral. Metals are especially prone to this behavior because they are not only assets, they are insurance. When protection demand outruns the number of willing sellers, spikes form. Not trends, spikes. The chart compresses time. That compression produces nausea, not fear, nausea. The sense that the floor moved before your balanced system could adapt. That reaction is not personal. It is structural. These episodes often arrive before rule changes, margin reviews, or collateral adjustments because markets tend to stress before they formalize new boundaries. Later, I'll show you the physical signal that tells us whether this was real accumulation or just mechanical relief. Because there is one behavior change that decides whether this move survives. Violence in price usually means someone had no choice. Facts versus interpretation. Credibility ladder. Before we build any narrative, we separate what can be measured from what can only be inferred. Fact. Volatility expanded across safe haven and collateral markets at the same time. That tells us uncertainty was being repriced system-wide, not inside a single asset. Fact. Spreads widened and intraday ranges grew. That tells us liquidity providers stepped back and the cost of immediacy increased. Fact. Metals moved in closer alignment with foreign exchange and energy than with equities. That tells us the response was routed through hedging and funding channels, not growth expectations. Now interpretation begins. Interpretation. Risk desks likely repriced geopolitical tail exposure and adjusted what they were willing to warehouse. Interpretation. A meaningful portion of the flow was protection and neutralization, not directional conviction. Interpretation. This type of cross-market behavior most often appears near transition zones, where positioning is crowded enough that small changes in assumptions force large changes in structure. We don't need to dramatize that. We don't need to minimize it either. We measure. We don't guess. Facts tell us what happened. Structure tells us why. And once we understand why, we can start mapping where behavior itself is likely to change. Next, we're going to locate the exact price zone where that shift usually reveals itself. After that, we'll begin comparing what paper markets are signaling to what the real world is quietly reporting. The decision zone. When forced flows collide with discretionary interest, price enters what we call a decision zone. This is not a technical buzzword. It's a behavioral location. It's the area where those who were compelled to act finish acting, and those who can choose begin revealing themselves. These zones almost always form around prior consolidation regions, because markets remember where large amounts of business were done. That memory is stored in inventory, in positioning, in volume profiles. When price returns to those regions after a shock, the market is no longer discovering value. It is negotiating control. If control is real, behavior changes before headlines do. Price compresses instead of expanding. Swings shorten. Pullbacks become shallower. Volatility stops climbing and begins to contract. You see higher lows, not because buyers are excited, but because sellers are no longer being forced. That is how a market tells you stress is being absorbed rather than transferred. Failure looks different. Retraces become sharp and impulsive. Spreads narrow quickly as liquidity providers step back in. Open interest contracts instead of rotating. That combination usually signals that the prior move was mechanical relief, not structural change. In metals, this distinction matters more than in risk assets because metals do not require optimism to hold value. They require the absence of compulsion. When forced sellers are gone, price behavior stabilizes even without aggressive buying. This is why the next decision window carries pressure. Not emotional pressure, structural pressure, because this is the region where fakeouts are born, where trends either gain legitimacy or are quietly unwound. Decision zones aren't about price. They're about who still has to act. In the physical market, the same zone looks very different. And once we account for that, we can walk the three possible paths forward. Paper versus physical. Every crisis move begins in paper. That's where leverage lives, where hedging is cheapest, where rules are enforced fastest. But paper price is not the market. It is the messenger. Physical behavior is the market. It is where decisions require capital, logistics, and time. That's why we always shift our attention off-screen after a shock, because this is where credibility is either built or quietly lost. What we watch first are premiums, not charts. Retail and wholesale spreads tell you whether urgency is being expressed by real buyers or just recycled between desks. If paper price rises while premiums remain flat or compress, that suggests the move is still mechanical. If premiums begin to firm across products and sizes, that increases the probability that protection demand is leaving the screen and entering inventory. Then we look at inventory and delivery behavior, not headlines about stocks, but actual movement. Which bars are being requested, whether loadout pace changes, whether delivery notices begin clustering. Bar size preference matters because it reveals who is acting. Small bars point to retail stress, large bars point to institutional positioning. Wait times matter because they expose whether supply is simply priced higher or actually becoming less available. Regional differences matter even more. Stress rarely appears everywhere at once. It migrates. One geography tightening while another remains loose often precedes broader physical repricing. This is why physical signals often lag the initial paper shock, then lead the next phase. Paper expresses fear, physical expresses commitment. When rallies persist without physical confirmation, they tend to fade as soon as mechanical pressure is relieved. But when physical behavior begins to change underneath a consolidating price, that is when paper eventually has to follow. One physical signal usually confirms the real trend. Without it, rallies remain mechanical. Paper moves first, physical tells the truth. And once we understand that relationship, we can responsibly map the paths forward. Scenario map. Breakout versus fakeout versus washout. From here, there are only scenarios, not forecasts, not convictions. Scenarios are simply structured ways to organize what behavior might look like under different mechanical conditions. They keep observation clean, and they prevent emotion from sneaking into interpretation. The first path is the breakout scenario. This is not defined by excitement. It is defined by stability. Price would begin holding above the decision zone without expanding its intraday ranges. Pullbacks would shorten. Volatility would compress rather than flare. Premiums would quietly firm instead of spiking. Open interest would rotate rather than collapse, suggesting positions are being transferred instead of abandoned. In that environment, metals are not being chased. They are being accepted. That increases the probability that the move was not just a reflex, but a transition. The second path is the fakeout. This is the one most people emotionally default to after violent moves, because it feels familiar. Here, price would retrace sharply back into or below the decision zone. Spreads would normalize quickly as liquidity providers step back in. Physical markets would remain soft, with little change in premiums, wait times, or bar preference. Headlines would lose their grip, and structure would quietly reset to where it was before the shock. That sequence usually tells us that forced behavior has concluded and nothing structural replaced it. The third path is the washout-then-hire scenario. This one tends to be the most psychologically damaging because it satisfies neither optimism nor skepticism. Instead of stabilizing, the market experiences another margin-driven event, another air pocket, another sudden flush that forces the last weak structures to clear. That is often where delivery behavior begins to change, where inventory signals tighten, where physical stress appears not at peaks, but after exhaustion. In that path, the next base is not built on enthusiasm. It is built on absence of leverage. None of these paths are guarantees. They are conditional frameworks. Each requires specific behaviors to confirm it, and they are time sensitive. The next 14 days matter because forced systems resolve quickly. They either stabilize or they don't. Which one unfolds depends less on headlines and more on one risk desk behavior that most people never watch. And I'll show you how to monitor it. Scenarios keep you solvent. Certainty makes you fragile. Risk, discipline. This is the point where it's important to restate what this channel is and what it is not. We measure. We don't trade. We analyze behavior. We don't chase price. That distinction matters most when volatility rises, because volatility is not danger by itself. It is information. It is the market telling you that assumptions are being renegotiated, and whenever assumptions change, overreaction is structurally punished. Not morally, mechanically. Systems built on leverage and emotion are the first to be removed when conditions shift. There is a difference between an ownership mindset and a price obsession. Price obsession lives in ticks. Ownership lives in structure. One stares at screens. The other studies flows, inventories, and constraints. In decision windows like this, patience is not a personality trait. It is a risk posture. Forced behavior resolves on its own schedule, not on our need for clarity. Acting before it resolves usually means acting on incomplete information. Fear inside these moments does not mean something is wrong with you. It means perception has shifted faster than your nervous system prefers. That is not weakness. That is biology encountering mechanical repricing. The discipline is not to suppress that reaction. The discipline is to prevent it from inserting itself into interpretation. Ego wants to be early. Structure rewards being correct. Detaching from ticks is not detaching from reality. It is engaging with it at the level where cause exists. When you do that, volatility stops feeling like chaos and starts reading like language. Your job isn't to predict, it's to observe cleanly. Next is the exact checklist I'm watching. These signals remove opinion from the process. What to watch next? From here, the work becomes quieter and more precise. This is where most people drift back to headlines. This is where we narrow to signals. Premium behavior, week over week, is first. Not day-to-day noise, but direction. Are real-world spreads firming, stagnating, or softening as paper stabilizes? That alone often tells you whether stress is transferring or dissipating. Alongside that, inventory behavior matters. Not reported totals, but visible drawdowns, load-out pace, and whether metal is moving or simply being repriced. Stagnant inventories during rising price suggest paper. Actual movement suggests commitment. Delivery behavior is the next layer. Watch notice patterns. Watch roll behavior. Watch whether obligations are being quietly extended or cleanly closed. These details reveal whether large participants are comfortable maintaining exposure or actively trying to reduce it. Hope and interest during consolidations is equally revealing. Expansion tells you new structure is being built. Contraction tells you the system is stepping away. Then there are the rule channels, margin discussions, collateral adjustments, funding commentary. These rarely make headlines when they start, but they almost always precede structural shifts. Cross-check that with correlation behavior. Metals moving independently is one thing. Metals moving in lockstep with FX and energy tells you the system is still operating in hedging mode. Finally, volatility itself. Does it compress as price holds, or does it remain elevated? Compression signals absorption. Expansion signals unresolved stress. All of this is time-bound. Forced systems resolve quickly. The next 14 days matter because decision windows do not remain open indefinitely. One of these signals has preceded every major metals move. If it changes, the whole story changes. Signals tell you before headlines do. Interactive close. Before we close this briefing, bring it back to the reframe we started with. This was not belief, this was forced behavior. And forced behavior always leaves evidence behind if you know where to look. That's where this channel lives, not in prediction, in measurement. So I want to hear from you. Which signal matters most to you right now? premium behavior, inventory movement, delivery stress, open interest, volatility, correlations, or something you're watching that I haven't mentioned? And second, are you seeing any physical tightness where you are? Longer wait times, changing premiums, shifting availability, different bar sizes moving. Your answers shape the next briefing because real-world observation often surfaces before reported data ever does. If this style of calm, mechanics-first crisis analysis is useful to you, make sure you're subscribed. This channel exists to track structural change while most people are still arguing about narratives. One last thing to hold in mind as we move deeper into this decision window. Margin rules and collateral frameworks rarely stay static after shocks like this. They adjust, quietly. And when they do, behavior changes again. We may already be inside the transition, and if we get another margin hike while price stabilizes, the next move could be faster than the last.